Hello everyone, welcome to Just-InvestToday, and in today's video we're going to be analyzing Bill Ackman. Yes, Bill Ackman is an amazing investor, and he's like an investor that you guys should be looking up to because he's made very good investments. But in today's video, we want to know what he did wrong so we can learn from those mistakes. Remember, learning from these mistakes that these investors make are going to make us better investors so we do not make those same mistakes. So in this video, we're going to learn from the mistakes that Bill Ackman made. So in 2014, Bill Ackman had really good success in the market. I think he beat the market by around 30 to 40% in the market. So he had really good returns, beating out the S&P. But then in 2015 and 2016, he had really strong struggles. So in 2015, he had like a negative 13.5 percent on his investments. And then in 2016, he had like around a negative 20% on his investments. So let's look at what he did wrong in some of these investments. So in this first part, I'm going to give you my thoughts on what I think Bill Ackman did wrong, and then we're going to hear from Bill Ackman himself on what he did to improve his stock returns in the future in 2018, 2019, 2020, and what he did right. So in 2007, Bill Ackman invested around $2 billion into Target. So Target was underperforming the market, and he thought he could actually move it around, have a shakeup in the stock, and see if he can uncover some value in Target. And in 2011, he actually decided to sell the shares because you got to think about it. He is an activist investor, so he tries to be really active. He tries to get on the management side of the investment. So when he did this, he got into a little proxy war with Target because Target didn't really want him on the board because he thought he could unlock some value. Because remember, Target was on a lot of land, and thought he could unlock some value by putting it into a real estate trust to get some value in that, get some more buybacks and stuff like that. So actually, what actually happened was that didn't happen. It didn't go the way he wanted it to go. So they got into a proxy war. Went to court. He couldn't get on the board, and he actually did not unlock the value that he wanted to. So then he sold his shares 4 years later in that investment. So guys, even though Target had a lot of value, we got to make sure that our goals are the same as management goals. Because in this story, Bill Ackman's goals were not the same as management goals. He had a different set of ideas than what management had, and that's when all the legal battles came about and everything came about. So when we think about this, we got to think about it like we just want to buy very good companies that are doing very well already with the same goals as us as management, because trying to turn around a company is very hard to do. So we got to look at these companies with competitive advantages so we don't have to really turn them around. We can just look for the short-term problem that's going to be fixed very soon, and we're going to gain all that way back. Because remember, Target had to deal with Walmart, which Walmart was a big juggernaut at that time. So you got to think about that too. So in 2012, Bill Ackman actually made a big investment. He actually shorted Herbalife. He thought that Herbalife was actually running a pyramid scheme. So that was his thesis for his shorting of the stock. So when you short a stock, you got to make sure that you know what you're doing. So I wouldn't recommend shorting a stock, but Bill Ackman is a very good investor, and he actually thought that Herbalife was running a pyramid scheme. So he put a short position into that. So that was his thesis on the stock at that time. So that $1 billion short position created a lot of drama in the market, and it sent shares flying down because the Federal Trade Commission actually wanted to investigate what the Herbalife was doing, seeing that it actually was running a pyramid scheme. So that sent the shares flying down, and they released an investigation. I think it lasted around like 2 years, and it came up they weren't. Carl Icahn actually didn't believe that Bill Ackman's thesis and actually went against him and actually invested in the company. Carl Icahn and Bill Ackman had a lot of exchanging of words, and they're fighting each other, claiming no, this is a short position, and Carl Icahn's like no, this is a strong company. In 2014, when the FTC didn't find anything wrong with Herbalife, the stock actually shot right back up. They found no allegations of a pyramid scheme. They didn't find any faults in the company's accounting practices or anything like that. So Bill Ackman's bet on what he thought was going to be a major collapse because they were running a scheme did not work out. So in around 2017, he actually decided to sell his position, and he I think he lost around 500 million to $1 billion on his investment. So, guys, even though I don't recommend short positions on stocks, I still want to look at the mistake that he made on this investment. I felt like that he was just assuming what the stock was going to happen and what was going to happen, but he didn't know for sure. So he was kind of guessing. When we invest, we want to have some kind of certainty that our projections, our thesis is right. So we really want to ask the question, can we see this company, is this company going to be bigger in 5 years? Guaranteed, yes or no? When we can answer that question, then we can put our money into that company if it's at a good price. But we have to answer that question first before we make an investment. We can't assume and kind of predict or try to act like we know what's going to happen. But as long as we think the company is going to be bigger in 5 years, that stock is going to be going up because we're always thinking long term when we're making investments. So one of the last mistakes Bill Ackman made was actually investing in a pharmaceutical company called Valiant. Valiant basically was making genetic drugs and for gastrointestinal issues, skin diseases, and yeah, they're making drugs for those type of issues. And in 2015, he actually invested $3.3 billion into this company. So during this time that Bill Ackman invested in this company, it got caught with a lot of questionable things it was doing. Questions about pricing practices and improper accounting allegations. Within months, the company was collapsing. Valiant was soon under fire for boosting drug prices, pushing them through dubious methods that were not completely disclosed to investors. There were so many questions over the company's accounting practices as well. So all that stuff actually hurt the stock price for Valiant, and Bill Ackman still supported the company. He didn't really believe in any of that, so he kept investing into that company, even though they were doing a lot of questionable things that kind of dropped the share price and people didn't really believe in. So around 2017, Bill Ackman actually decided to sell this company. He actually got a $4 billion loss, and it was just too much problems with this company. There's too many issues and too much uncertainty with this company. A lot of debt fueled acquisitions and just dubious stuff that they were doing, and he decided not to believe them as much anymore, so he sold those shares. Even though Bill Ackman lost a lot of money on this investment, he actually came out learning a lot about this investment and what he can do in the future to make sure he doesn't make these mistakes again. So he found out that managers' competence in deploying capital doesn't always translate into value added for a business. Changes in regulations, politics, and other intrinsic factors can always be accounted for. Knowing what you don't know is always something sometimes hard to find. Strong management teams can still make mistakes. Charlie says you want a company that a fool can run because one day a fool will. Finding companies with strong moats can still do well even with bad management at the helm. So these are things that we got to look out for, and this is what he learned with this Valiant investment. Even after all these bad mistakes that Bill Ackman made, let's hear from him, see what he has to say about this. As investors, we always gotta get back to the basics of what we did before and how we can keep those returns.
So let's talk about for a moment some of the campaigns you've done as activists. Some of them have worked out, some have not. Chipotle seems to have worked out, but you did a couple that were difficult ones. So Herbalife or Valiant, they didn't work out. What would you say is the mistake you made in hindsight and that you would try to avoid in the future?
Sure. So there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after the 2000, we went through a very difficult period, circa 2015, 2016. The 2 investments you mentioned were big drivers of that. It was if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy. It sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
If you like what I had to say, can you please like this video and subscribe to my channel? And I'll get you back at the next video later.